Welcome to the daily update, where I'll go over the action in the market for Friday, June 14th, and then I'll go through and see how things look for Monday, June 17th. Had a slight down day. We did recover off of the lows. However, there's a lot of negative divergences that are just becoming more and more and more pronounced, and we have to respect those. We're not seeing it reflected yet in the price of the S&P. We have the NASDAQ and NASDAQ 100 hitting new all-time highs, but it's just a small group of stocks that are really leading things higher, and these are the big cap stocks, and so that's what's influencing the indexes right now. But when we look internally at the S&P, we're seeing not really a breakdown, but we're seeing some real negative things developing that we want to be aware of. We're also short-term overextended to the upside, which may call for some kind of a pullback. We saw a little bit of that worked off on Friday with the slight down day. On the positive side, it is encouraging that we're setting the lows earlier in the day or about halfway through the session, and then we're seeing some strength going into the close because it's the amateurs who open the market, it's the professionals who close the market, and so that is encouraging. Our smart money indicators are still showing strength, but the internal measures that we look at are really showing some weakness right now. Please be aware that the SPXInvesting Program has now launched. It's free for the month of June. I will be locking that down in July, and I'll be rolling out some additional things once I get it locked down. I just want to give folks a chance to look it over and see if it's something that they are interested in. And then I'll be posting updates from time to time on the YouTube and Rumble channels just about how things are going. If you want to talk to me about this, here's an email address. There's a link in the description below these videos to take you to a playlist on YouTube or just a bunch of videos on Rumble that talk about the program itself. And then there's another link also that will take you to the SPX Investing website. I've been pointing this out for the last couple of videos. There's a gentleman named Bob Kendall. He's been around a long time. He's not always positive. He's not always negative. He likes to look at things for what they really are, which is the way I like to look at things. And he came out with a report a few days ago suggesting that interest rates are going to decline. At first, it was looking like they were going to go all the way back down to zero. That could be due to some kind of a bad event that happens in the US. He's backed off that a little bit lately. And in Thursday's session, he did put out a report that's freely available to everyone where he addresses this a little bit more. And right here, here's a chart that he goes through just showing how he is projecting that interest rates will go down, not quite down to zero, which is what he was saying in another YouTube video that I have a link to here. He's modified that a little bit, and this will change. This is a model that he uses, and as new data is coming in, that model will readjust. And the Fed uses a model, big hedge funds use models. I mean, it's a very common thing to do. My form of a model is to use the approach that I do for technical analysis by going through as much information as possible and then reaching a conclusion that way. It's not necessarily computer-based, and the computer doesn't necessarily figure this stuff out. I do it more myself. But to come up with some kind of an approach like this is very common. However, this can also backfire. It was models that led us into the great financial crisis back in 2008 because those models said, oh, everything's just fine. And then they broke down and caused a lot of consequences that weren't anticipated. And that ended up melting down the global economy. So we have to be somewhat just leery of those things. But this is a gentleman, I subscribe to his newsletter. It's $8 a month. It might be worth subscribing to that as well. I don't have any connection with him at all. I don't get a kickback or anything like that. I'm just trying to put the best information that I know about, even if it's outside of what I do, out there for you to make better decisions, because that's a real focus of what I want to do here. Okay, let's go back and talk about what happened, and then I'll go through some charts. We did have a lower open. The futures were negative. There's some situation going on in France right now concerning kind of the election process. And is France going to leave the EU just like Great Britain did and all those things? We don't know what's going to play out there, but there's just some speculation going on. And that carried over into the European session, which then carried over into the US session. So the futures were quite negative, but not necessarily based on things going on in the US. So we had a lower open and prices declined down below S1 at 54.10. We did find support at Thursday's low. So that's looking pretty good right now. We set up some support there, and we were also able to stay above the 5400 level. Then we chopped our way back above the daily pivot at 54.26, and then we chopped more after that above and below the daily pivot until we closed slightly negative. We were down 0.04%, technically unchanged, but that's the negative side, is that we closed down. The fact that we closed pretty much at the intraday high, that is more encouraging as well. So there's some positive things to take away from that, but it does go in the books as a down day. We dropped back to below average with volume. We are positive in the short, intermediate, and long term, but we're not showing an awful lot of underlying strength right now. We need to see the broader market come back in and start to participate. So far, it's not having an impact on the S&P. It's not impacting the NASDAQ or the NASDAQ 100. But at some point, this could come in and have an influence. And it's about inflation and interest rates. Interest rates have been declining, and that's been giving a real foundation of support for stock prices to go higher. And then all the different geopolitical things. I don't have France listed here, but it's something that did cause a little bit of a problem in Friday's session. We'll see if there's any more carry through with that. Some comments. Both the NASDAQ and NASDAQ 100 set new all-time highs. It was a mixed day again with more of a negative slant. We're seeing things really not looking all that positive other than a few select stocks. The mega caps outperformed. These are the ones that are holding up the market currently. And this is the political uncertainty about the French elections. This stirred speculation that they might end up leaving the EU if the left-wing bloc wins. It's a different kind of politics that take place in France than what takes in place in the US. Their whole political line between left and right is different in France. Actually, that's where we get the term right wing, left wing from, was back from the French Revolution. But how you plot things out and what the ideologies of those that believe different things, it's slightly different when you look at it on a European basis versus an American basis. But anyway, there's just some instability going on right now. And consumer sentiment came in weaker than expected. Some folks are just not feeling really good about their jobs. They're not really feeling good about inflation. And so we saw that really tick down. And I'll show you that here in just a moment. We are seeing a lot of these negative divergences, which are becoming more pronounced, and they're just not going away. In fact, if anything, they're getting worse. On a short-term basis, our list is pretty long. We have Stochh RSI, the Williams percent R, CCI 14 and 20, the stochastics, the RSI based on 9 periods, and the boom indicator based on 20 periods. Intermediate term, we still have the CMB composite, which is extreme. The Arun is ticking down a little bit, but still extreme. The Sean trend meter also ticked down, but still extreme. The Chaikin oscillator is actually looking pretty solid right now. The ultimate oscillator and the money flow should have been on the list yesterday. Well, it's now off the list for today's video. And then the RSI based on 14 periods. And I haven't really changed this, but we have seen a little bit of a shift in the general scenario that we're working with, that the Fed is keeping rates higher for longer. And now they're thinking like, okay, maybe higher for longer. Sometimes they've left them higher for longer for too long, and that ends up doing some damage. That's kind of some little bit of a how they're answering what the Fed is actually doing right now. And there's always things going back and forth, and everybody thinks they're always right. And now it does still look like, and I'll go over this over the weekend in the weekly video, that if we do get a rate cut, it could be in September. And there's one rate cut now instead of what the market had been anticipating as having as many as 3. The dollar was down and interest rates were down. This helped give some support to stocks later in the day. Interest rates have really fallen. We're down at 4.22% as of Friday's close with the 10-year yield. We had been at 4.24%. We're still inverted with the yield curves. And then this is one of the things that we're seeing because of these negative divergences. The S&P is going up and sentiment is going down. Well, because they're using some of the broader market internal measures to come up with the sentiment gauge at cnnmoney.com, and that's weakening how we're reading sentiment in the market right now. We're coming in at 38 where we had been at 43. And then now we are seeing a confirmed trend, though. The ADX has crossed above 20 and it's above its moving average, and the green line is on top. So now we are in a confirmed positive trend. But we're mixed right now when it comes to the bias because of the slight down day. And momentum, I'm still keeping it positive for right now. And for those of you that are kind of new to these videos, the only real subjective thing that I do where I come up with my own opinions would be the bias and the momentum. That's kind of my own take. I try to let all the charts speak for themselves. The economic reports, I'm just going to read through the numbers here. I don't have charts to go with this. Import prices were down 0.4%. Last time they were up 0.9%. If you take out oil, they were down 0.3%. Last time they were up 0.7%. Export prices were down 0.6%. Last time they were up 0.6%. When you take out agricultural products, they were down 0.8%. Last time they were up 0.7%. So you can kind of see a theme going here. We're seeing a drop in import and export prices. Consumer sentiment. This is a bit of a concern. This was kind of the bigger report that came out in Friday's session, where we got the 65.6 reading lately. They expected it to be at 73. Last time it was at 61.9. So they thought it was going to go up as people are potentially feeling better about things. They're actually feeling worse. Here is the chart showing consumer sentiment. Here's the blue line where we were up into the 70s, the high 70s here, and now it's beginning to drop back down. I also plot this with the 2-year yield just to give an idea of where interest rates are at. We were starting to see this close up a little bit, but now the spread between the two is beginning to widen again. Then looking at the top 10 mega caps as a percent of the S&P, it's 37.38% as of the time of this chart. Then you have the rest. This is the Marianne and Professor part of the economy right now. Some of you will know what I mean by that. Weekly equity fund flows, we are seeing money going back in. We're above the zero line, so folks are feeling a little bit more positive with the 12-week average, and we're just barely positive here when we look at it more on a raw score. Then looking at the indexed return, where if you take Apple, Amazon, Microsoft, Google, and NVIDIA, we're up 32% from, well, here it goes back to December 2023. So roughly the beginning of the year. Or the S&P, if you take it all by itself, it's up about 13%. If you take out, or if you just look at the equal weight S&P 500, it's up, but it's only up 5%. And this just, again, shows that the big stocks are really leading things higher. I didn't find anything on Twitter. I really didn't spend any time there. Here is the intraday chart where we did gap lower down below the daily pivot. We came down, we dropped below S1 and it looked like, uh-oh, maybe we're going to see more of a substantial decline. No, we ended up finding support at Thursday's low. We bounced up off of that, and it wasn't a strong move. We kind of just chopped our way higher, got above the daily pivot, fell back down, got above the daily pivot again, and then for the day, we actually closed at the high. And you could almost make a case that we filled the gap from Thursday to Friday's intraday chart. Looking at this intraday chart, not really much different than what we're seeing. The futures did drop off negative. This is about the time when things opened in Europe. I'm sorry, this is the cash session where we were looking a little more more negative to begin with, and then we came down, and then we're able to come up off of the lows. So that's rather encouraging. We're still looking good here. When we look at growth versus value, the blue line is above the red line on the intraday chart. And we saw an improvement with the end of day charts that I'll show you here. Also looking better here with the S&P growth to value ratio intraday. We were up with growth where value was down. We were down more with the mid caps and down a little bit more with the small caps. So looking at our ratios, with the small caps tick down a little bit, not really showing any strength right now. Mid caps, a little bit of a tick up, but again, not really showing an awful lot of strength. We are seeing an improvement here with S&P growth to value, and this is mainly the big stocks that are controlling this actually going higher. So this is still looking okay. And our growth to value ETF study, we were up again, where this is just showing that growth is outperforming value. But discretionary, it was down. Actually, yeah, it was down, but staples were down a little bit more, but not quite as much. So we saw the ratio coming down slightly here. Large cap growth doing pretty well and just hanging in there, setting all-time highs with this ETF. When we look at the ratio between large caps and small caps, the large caps are just really outperforming the small caps, as small caps are now under pressure. The Wilshire is still holding up quite well. That's a broad market measure. Here's our trend showing that the black line, that's the ADX, that's the main indicator. It's now crossing back above 20, and it's above its moving average. So that's when I say we have a confirmed trend. That's what we're seeing. The green line did decline, but it's still on top, so we still default to positive. And we're also seeing that in the short term. We're seeing now a short-term trend, and it's positive with the green line on top. Volume did drop off, but lately we've been seeing above average volume. So volume has been more healthy lately. We are kind of going sideways right now with the ulcer index, showing there's not a lot of fear, and we're below the moving average. The latest reading from Investors Intelligence came in at 3.43. We could still go higher than where we're at right now. So we're not getting an extreme reading. We ticked up with the VIX on the line chart where we closed higher. And we're also looking a little bit higher, but closed about in the middle of the bar when we look at the bar chart. And the volatility of the VIX, it's picking up. Folks are doing a little bit of hedging and maneuvering, especially ahead of a weekend. And the smart money knows what's going on here. They see these negative divergences. So you might see some things being put in place that make these indicators actually show a little bit of movement. And this is also coming into view right now. The skew index, I showed this for Friday's video. We were a little bit up into the red area after Friday's session. For Monday, we're going up even higher into this red area. Now, again, we don't really know. Is this going to suggest an up move or a down move? We have times when it's shown both or a continuation, but the market is expecting some kind of a big move. Is that going to be to the upside or the downside? You can make a case for either side. We're looking positive, and positive generally leads to positive, but these negative divergences, that's negative, and you could make a case that we could decline from here. And the volatility index here is measured by the VIX, trying to measure the direction. It's pretty much right on top of its moving average. We had been coming down with the VIX, but in Friday's session, it went back up. So we're looking at the MACD for that. Where we really shot up after Thursday, we came right back down after Friday with the equity put call ratio, but our 5-day chart is still continuing to go up. The volatility risk premium is still above this upper band right now. That's showing that there's still quite a bit of fear in the market as measured by this. We declined with this fear gauge, where we're still going up with this other fear gauge. So seeing a little bit of a contradiction there. This is what's causing some concern. We have the S&P coming off of setting all-time highs, and we're seeing a real negative divergence with price. It's actually going lower. We're hanging in there a little bit better with volume. At least it's maintaining more of a sideways move, but based on price, that is causing us some concern. We're also seeing a drop off in the new highs and a little bit of an expansion in the new lows. So our 5 period is starting to roll over, and our 10-day is also starting to go back down. This is another internal measure showing that there's some potential weakness developing inside the S&P. We're also looking more negative here. We've dropped below the 0 point, both with the 19 and 39-day exponential moving averages when we look at the advanced decline ratio. But this is still looking strong. Accumulation distribution is above an advancing moving average. Chicken money flow going back up now, also showing strength that the smart money is in there buying. And the chicken oscillator is also going back up. But when we look at the cumulative NYSE advanced decline line, we really dropped off. With that, we're coming back down to the 50-day moving average with our regular advanced decline line, coming back down to the 50-day moving average with our other NYSE advanced decline line. And we're dropping now with common stock on the NYSE for the advanced decline line based on price as well as volume. The positive divergence that I was seeing with volume, that seems to be going away now. And the advanced decline line cumulative basis for the S&P based on price, it's declining, but it's actually holding up a little bit better with volume. So in the broader market, we're not seeing volume still hanging in there. We're still seeing it hanging in there when it comes to the S&P 500. And we're seeing some breakdown here. The advanced decline line studies dropping below the moving average with the NYSE common stock, dropping below the moving average with the S&P, which is the strongest of these indexes right now, and seeing further weakness with the mid caps and the small caps. So our daily chart, not really much to show here. Unless we see more weakness, we have a pivot point below current price, but we're still above the 50-day moving average, and this trend line is still going up. If we do start to fall, we might see some support brought in there. And on the bottom, we drop to below average with volume there, but we're still extreme with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20, and with all of our stochastics charts. We're still looking good here with our 20-period double and triple exponential moving average study. We're just coming right back down in between the green line and the blue line, but we're not necessarily breaking this line of support. But we're going down with our 20, 50, and 200-period moving averages when you measure it based on the S&P 500. We did decline a little bit, but we're positive with the force index. We're still above the 20-period moving averages. So this means that the short-term trend is still positive. And we came down a little bit. We're right on the border between the +2 and +3 channel. So I'm taking this off of being the extreme positive right now. Looking at our standard deviations chart, we're still extreme when we measure the distance of how far we are away from the 20-period moving average. We're no longer extreme with the 50, and we're still looking okay here with the 200. The balance of power ticked down, but it's still above zero. That's positive. The go, no go has the dark blue bars. That's positive. The highest high value is still positive. The TTM squeeze is starting to go back up with the lighter shade of blue. That's positive. We're still above both lines here with our 50-period double and triple exponential moving average study. And so that means more intermediate term. We haven't come down really to test this support, at least yet. The CMB composite is still extreme positive. The ease of movement is still positive. The Arun did fall down just a little bit, but still you could call it extreme positive. And this is where we're seeing some internal weakness. The S&P McClellan oscillator, it's declining. And here we have the S&P setting all-time highs and going up, where the S&P McClellan oscillator is going down. That's classic negative divergence. So when the McClellan oscillator is negative, now we're declining with the summation index based on price and volume. And we're seeing that same thing with the NYSE McClellan oscillator, declining below zero, that's negative. And with our summation indexes based on price and volume for the NYSE, they are declining. We're also turning more negative now with the Swenlin trading oscillator. We're below zero based on price and volume. And this is also interesting. When you look at the PMO by itself, the momentum is going back up. But when you break it out based on price and volume, we're declining. So we saw a little bit of a weakness with the PMOs that are rising, starting to turn down with the buy signals and down to flat with the PMOs above zero. We're still positive for the S&P with the Elder's Impulse system. The parabolic SAR is positive. The slope oscillator showing momentum continues to be positive, and the MACD is looking positive. So all of our oscillators are turning back up. Even the longer term ones are now starting to go higher. So we're still looking positive there on a momentum basis. We're still above all the plotted moving averages. The bullish percent index, this is, well, it's positive because it's above 50, but it's not really breaking out. It just means there's not a lot of point and figure buy signals being generated inside the S&P right now. That's the negative side. The positive side is there's not a lot of point and figure sell signals being generated. So that's why we're above 50. And the NYSE bullish percent index is declining, but still above 50. This is looking better. This is the NASDAQ 100 bullish percent index, which is above 50 and continues to go up. The money flow, after being extreme, is now starting to drop back down, but it's still positive. And the ultimate oscillator is still extreme positive. The vortex rolled over a little bit with the green line, but it's still positive since the green line's on top. We're still extreme with the RSI 14 and the RSI 9. On balance volume, ticked down a little bit because we had a down day, but we're still above the advancing moving average. And here's the stocks above their 20-period moving averages. S&P is going up. This indicator is going down. That's a negative divergence. We're not really seeing any strength now with our 20-period moving average study. We'll have to see if that kicks back into gear. When we look at this a year ago, it had the thrust up and then it kind of went sideways for a while. And then it came down and actually showed some weakness as the market was bouncing around before it got set to go higher. We're seeing a little bit like that now, where we shot up, showing good thrust. Then we didn't go sideways for as long. Now we're coming back down to about the same levels that we saw before. So it doesn't mean that all hope is lost necessarily. It's just eventually we're going to need to see the rest of the market to really kick in to have this market maintain its positive stance. And we're negative with the 50-period moving average study. We're below 50 and declining. We're below 50 and declining with the 100, and we're declining but still above 50 with the 200. The copy curve is turning back positive. This is another momentum oscillator that's looking a little more positive these days. The Sean trend meter did decline, but it's still extreme positive. And we're watching standard deviation as price tends to be slowing down just a little bit, but we're still above the moving average, meaning that it's picking up this big move that we saw going up. Percent B indicator is no longer extreme. It's right on the border. So it just came back inside the upper Bollinger Band. So it's no longer extreme. And we're looking a little more negative here. When we look at the 5-period moving average of the highs minus the lows across the broad market, we're dropping below zero again. And then looking at a weekly chart of the S&P where we're hitting this R2 level, this could be providing overhead resistance. And it's at the 54.31 level. This was a big deal earlier in the year when we were dealing with R1. Now we're wondering if we can get through R2, or is this going to produce a pullback? If you haven't seen this in a while, the reason why I watch this is if you go back to 2021, where we were going up something fierce after the COVID plunge, we hit one of these actually, this is a quarterly pivot point. It's on a weekly chart. That's why you see the line lasting for an entire quarter. But we hit this point, and then boom, we ended up going into 2022. And then we were coming back up. And then last summer we hit this point, and then bam, we had a 10% correction. Well, we were able to break through it. We actually broke down below it earlier on, but then we were able to recapture that. Now we're dealing with another one of these, and we're wondering, is that going to be an issue? But on a trending basis, we're still looking positive with the hike in ASHI, with the KEGI, with the Renko, and the 3-line break. We're still showing a little bit of longer-term weakness here, but we're positive with the 150 and 200-period moving average study. You can see how these are drifting off as the S&P is going up. And we have not received a confirmation yet for the Hindenburg-Ullman based on the NYSE down here on the bottom, but that's being applied to the S&P 500. We have until around June 18th, which will be Tuesday, for that 20-day window to finally close. Now, there's something I do want to show you, and I don't have any annotations on here. This is the NASDAQ, not the NASDAQ 100, but the NASDAQ itself. It is generating multiple Hindenburg-Ullman signals. These are confirmation signals. So this is a concern to us. And this could be potentially negative, but we haven't seen a confirmation of that yet in the S&P 500, nor has it confirmed what's being said here in the NASDAQ 100. And that's because we have a large number of stocks that are leading things higher. And that means the rest of the NASDAQ is not doing all that great. And the Hindenburg-Ullman signals are picking that up. And that's why we're seeing a real spike up in multiple signals now. We want to be aware of this. The perma bears are just salivating, looking at this going, oh my gosh. But we have not seen it. We have not seen a confirmation yet with the S&P. So we'll be waiting to see if that happens. And now, because we're getting so many signals here, and I may put some words on this chart and just show it while this lasts, these signals are being generated more recently. So that means that 20-day window is going to be even more extended. So I'm probably going to add this to our daily chart just to keep an eye on this. And we're negative with the mid caps and the short caps, small caps. My goodness. Mid caps and small caps are negative in the short term. All right. And we're still negative with bonds based on price in the long term, negative in the short term with commodities. No changes with the decision point scorecard. Saw a lot of red here. We had a BPI below 50 for the NASDAQ, not the NASDAQ 100. Healthcare, that's a more defensive area, and that saw a bearish MACD crossover. That could actually give support to the market, as well as when energy's more in defensive mode, we saw a BPI cross below 50. The NASDAQ got below 17.6, but then ended up setting a new all-time high. The dollar showed a little bit of strength really going into the close. It dropped down. It was down for the day, but it dropped below 105 and then went back above it. And then materials, which can be more economic / defensive at times, it's also seeing some weaknesses. The BPI crosses below 50. So looking at our sectors, we had tech and communication. These are the strong areas. These are the strong areas. These are the stocks. The mega caps are in these areas, and they were up on the day. We did see a bit of a bounce with staples here, but all the other sectors ended up being negative. And we're starting to drop negative with our raw score. When we take the NYSE new highs minus the new lows, we've been above zero. The moving average is still above zero. Now we're starting to drop below zero. That could be showing some internal weakness. And the equal weight, my goodness, this is just skyrocketing up here as the mega caps are outperforming the equal weight S&P 500. The Dow's not really doing all that much. It was down, but it's still below its 50-day moving average. So it's maintaining being negative with the Elder's Impulse system for the diamonds. NASDAQ coming back, setting a new all-time closing high. Not an intraday high, but we did set a closing high. And we also set another new all-time high with the NASDAQ 100. So we're positive with the Elder's Impulse system with the QQQs. The momentum for the NASDAQ 100 is positive. Small caps dropping below this S1 level, below its 50-day moving average. We got up into the higher end of this range, and then we saw some selling coming in. So we have gone from positive to neutral to negative with the Elder's Impulse system for the small caps. And when looking at the Russell 2000 small caps, we're below 50 and declining. We're below the 50-day moving average here. And the momentum is also negative for the small caps. The mid caps not showing an awful lot of strength now, still below its 50-day moving average. We're still above this S1 level, but we're not seeing a real thrust up. We want to see the mid caps doing better. They gave some support earlier in the year. We bounced up off of the April lows and then saw nice gains after that. We're not seeing that kind of movement, at least yet. And we've gone from positive to neutral to negative with the mid caps when looking at the Elder's Impulse system. Apple, a little bit of profit taking here, but coming off of setting all-time highs. Tesla struggling, down 2.44%, still dealing with its 50-day moving average. Nvidia up, and everybody's darling stock right now. Microsoft was up and looking healthy. Meta was up a little bit above its 50-day moving average. Amazon dealing with its 50-day moving average, but still in an uptrend. And Google, it's been chopping sideways quite a bit, up 0.93%, but not setting an all-time high. Netflix is starting to break out and look a little bit better, but it still has a ways to go to get back to its previous all-time high. And the FANG index set another new closing all-time high, but not an intraday high. The financial sector, seeing a little bit of weakness here. We're dropping a little bit below the 50-day moving average. But the staples to tech ratio, this continues to go down. That means that staples are underperforming tech, and that's more positive. The dollar ended up closing above 105. We're still in an uptrend, but we had been seeing a bit of a pullback, which was giving support to stocks. We're kind of going out of line here. When we look at the S&P and compare it with the world index, the short-term relationship is really dropping off as the S&P has been going up, but world stocks have been more under pressure. The longer-term correlation is also just starting to turn down. The staple sector ended up being up. It's still above its 50-day moving average, still in an uptrend. Utilities coming down, not quite to their 50-day moving average. They were down slightly, but still looking solid. Healthcare, virtually unchanged, but down just slightly, but above its 50-day moving average and still in a longer-term uptrend. Energy is coming down and testing its 200-day moving average. That's kind of interesting. And the total U.S. stock ETF was down a little bit, so it did not set a new all-time high here. We are really seeing a drop-off with interest rates, with the 10-year yield. We were at 4.45% just a couple of days ago. Now we're at 4.2%. Just about, near the end of May, we were at 4.65%, and now we're down to a little bit over 4.2%. That's quite a drop in interest rates. But that's what's been giving support to stocks. So we're going up when we look at this based on price with the 7 to 10-year bond ETF. We ticked down just a little bit with our ratio, but we're still looking at a positive ratio here, meaning the market is anticipating a soft landing, meaning we will not go into a recession. And the Qs versus 3 to 7 year bonds, that's just continuing to go up as the Qs outperform. The tech sector is also outperforming bonds. That's going up. And we're seeing a decrease here with the tips to 7 to 10 year bond ratio. This going down could be positive. That means that folks are tending to lock in longer term rates, thinking that maybe they've topped out and they're not as concerned about inflation or interest rates right now. And then 1 to 3 month T-bills, which is cash, to 3 to 7 year bonds. This is coming down. Even though the ratio is still in an uptrend, we want to see this continue to decline. Then looking at our growth to value ratios, really looking good here with the Qs to S&P, looking terrible with discretionary to the S&P, and looking good when we compare large cap growth to large cap value. So the large caps are looking good, a little bit of an improvement with the mid caps, and above the moving average, but going sideways with the small caps. This is turning more negative now. We've dropped below zero with our 19-day advanced decline ratio based on price. We're now dropping below zero based on volume. But this is looking more positive. The S&P to utilities ratio continues to go up. This is also positive. The Staples to S&P utility, the Staples to S&P 500 ratio continues to go down, and that's positive for the S&P. So what's our outlook? The stock market will be closed on Wednesday, June 19th for Juneteenth. And then on a technical basis, we are still positive right now, but we're seeing these negative divergences and they're not going away. If anything, they're getting stronger. We won't have any economic reports on Monday, and we want to see what crazy things will happen in the world. If things start to really escalate in France, I will put that on this list here. And then here's the economic calendar. And the reason why these are blue is because the stock market's closed that day. So I'm not sure what's going to happen with that. I'm seeing a little bit of a discrepancy, and that's what happens quite often when we have a holiday. I look at two economic calendars and they're giving me slightly different stories. So I'll adjust this as needed. No economic reports on Monday. We're going to get retail sales. That's a big one. And industrial production and capacity utilization on Tuesday. Not sure when these are going to come out. And we're going to get our usual jobless claims on Thursday. And we're going to have LEI on Friday. And I'm just marked out what's happening on Tuesday. That's probably the biggest economic report of the week. Seasonally, we're neutral to positive for June 17th, where we're flat out positive for the S&P and NASDAQ. And then Monday is the most positive day of the week. And I need to go back and show something here. I didn't highlight this, but we're coming into options expiration week, where we tend to be up 54% of the time and we're down 46% of the time. Not a real big edge from one side to the other. But Monday is more positive. And then looking at the election year, we see a little bit of positive seasonality, which is carrying through until about the 20th of June before we see some weakness going forward from here. And then Tom Bowley has us coming back into the more positive side of things, where we're into this June 12th through 17th period. Then the warning signs, staples and utilities, we're just keeping an eye on that, as well as energy and healthcare for right now. The advanced decline line, we're seeing weakness there. That's not boding well when you have the S&P close to all-time highs, and not only the S&P advanced decline line weakening, but across the market. That's not showing a lot of conviction. The equity put call ratio is still going up. That tends to be more negative. Growth to value is improving. We're actually seeing a bit of a breakout for the S&P, but the discretionary, but the discretionary to staples ratio, that's really not doing quite well these days. We're still negative with the McClellan oscillators and summation indexes for both the S&P and the NYSE. That is a big time negative divergence. The Swenlin trading oscillator is negative. And we're below 50 with our 20, 50, and 100 period moving averages studies. So they are negative. But we're looking good here. The parabolic SAR is still positive. And with our 3 smart money indicators, they're looking pretty stellar right now. Maybe a little too stellar. Maybe we're with the accumulation distribution. Maybe we're getting a little far away from that moving average. I wish I had a way to measure that, but using stockcharts.com, I just don't have that ability. So you have to kind of eyeball it. Our oscillators are turning positive. The bullish percent index is above 50, but it's not really showing an awful lot of strength. The money flow and the ultimate oscillator are positive. The vortex is positive. The Copic curve is positive. The financial sector is positive now, but we've been showing some recent weakness here. The momentum for the NASDAQ 100 is positive, and we're looking positive with the bullish percent index for the NASDAQ 100. So our conclusion, we're positive, but these negative divergences are really causing some concern. In the short term, we are improving and we're positive, but we're still overextended and we don't know. Does that mean we're too far positive and due for a pullback, or is that suggesting good momentum? Intermediate term, we're positive, but this is where we're seeing a lot of the negative divergences really begin to develop. But in the long term, we still continue to be positive. Thank you. I really hope you found this helpful. I will be posting the weekend videos over the weekend. So I hope you have a really nice weekend, and I will talk to you in the next video.